Welcome to Ultimate Options Trading. In this video, we're going to be talking about selling naked puts. Now, unlike some of the other videos we've done on different option strategies, when you sell naked puts, that's what we call an undefined risk strategy. So it's a very simple strategy to implement, but because you have unlimited risk, there's a few critical pieces of information you really should know before you attempt this type of trade. So if that sounds interesting, stick around and we'll see you after the intro. All right, let's get right into it. So like we mentioned, unlike some other option strategies like spreads, iron condors, and those types of strategies, when you're selling naked puts, it's an undefined risk strategy. So what that means is, as long as you're holding that position, you have unlimited risk to the downside. So because of that, there's a few things you want to make sure you understand before you get into this type of trade. Now, I probably should mention, before I get into the details of this, we do have another video, and I'll post a link right here on what's called the wheel strategy. Now, the wheel strategy is very similar to what we're doing here, except one major difference. In the wheel strategy, when you sell naked puts, you're doing it with the intent or with the expectation that the stock price will move down and you'll get assigned those shares so that you can sell calls against those shares. So if you're not sure what I'm talking about, check out that video and yeah, you can learn all about the wheel strategy. But in this case, when we're selling naked puts for this strategy, we don't want to be assigned the shares. What we're trying to do with this strategy is basically we're just selling the put, collecting the premium, and we want to make our profit based on that premium that we collect. Now, one key thing to keep in mind, because of the risk, because of the downside risk to this trade, there's two market conditions where you want to use this type of strategy. You want to use this strategy either in a bull market or in a sideways choppy market. The only time you don't want to use this strategy is if you're in a strong bear market. And the reason for that is if you're in a bear market, even if you're selling a 20 or 30 delta, the chances of that stock pulling back and hitting your strike price or getting below your strike price are pretty high if you're in a bear market. Whereas if you're in a sideways or bull market, the chances of your strike price being tested are pretty low. And actually, one other thing you should be looking at, so again, if you have either a bull or sideways market, you want to look at the implied volatility ranking of the stock. The higher the implied volatility ranking, the higher the likelihood that this strategy will work. Because again, if the implied volatility is high, over the next couple weeks or several weeks, there's a good chance that implied volatility is going to decrease or contract. And as it does that, that reduces the cost of the option price, and that just works in your favor to being able to get out of this trade with a profit. So keeping that in mind, let's go over how to set this trade up. The first thing you want to do is anytime you're selling a naked put, you want to look out about 45 days till expiry. Now, research has shown that when you're going out about 45 days, that gives you the best risk reward scenario for the long term. Now, of course, you're going to have trades that lose, but you'll have more trades that win, and you'll make more money over the long term if you're targeting about 45 days out to expiry. Also, when you're picking your strike prices, you want to pick a strike that's somewhere around a 20 to 30 delta. And again, that's just, looking back at all the past historical option prices, we just find that when you're selling options, if you're targeting that 20 to 30 delta, again, that means you only have about a 20 to 30% chance of that option expiring in the money. So in other words, you have a 70 to 80% chance of expiring out of the money and being profitable on the trade. That over the long term, that's kind of the sweet spot of where you want to target for these types of trades. All right, so let's say you're in the trade now. Let's say you sold a 30 delta put, approximately 45 days to expiry. So now how do you manage the trade? So of course, there's two possibilities. Obviously you can have a winning trade or a losing trade. So let's look at the easy side first. Let's say you have a winning trade. On these types of strategies, basically what we're doing is we're targeting a 50% profit. So in other words, let's say you sold this put for $2. You want to buy it back at approximately $1, take your 50% profit, close out the trade, and move on to something different. So really easy on how to manage these when you have a winning trade. And again, you'll have a winning trade fairly quickly if the stock starts moving up. And also, even if it's moving sideways, just that time decay is going to give you that profit fairly quickly. Now let's talk about the flip side. What if the trade starts going against you? Well, knowing how to manage this type of trade can make the difference between taking a really significant hit or taking a small loss, or maybe even getting back to even if you manage the trade properly. So what you want to do is, as long as the stock price is above your strike, don't do anything. One of the worst things people do with these types of trades is they overtrade them. The stock will start pulling back. It might start getting close, maybe $1 or $2 away from your strike price, and you panic, you close out the trade, and then the stock bounces, and it would have turned into a profit. So what I do, as long as the stock price is above my short strike, I leave it alone. Just let the time decay work, let the option strategy work. Now, if the stock price does start to get below your short put strike price, that's when you want to take some action. Now, it depends on how far out you still are from expiry. Hopefully by this point, a week or two have gone by, so you're not around 40 days anymore. What you want to do is, if the stock starts getting below your strike, the best thing you can do is roll out to a future month. So hopefully you're around 30 days already. So now you roll out to the next month, you collect some additional premium, and you give the trade some time to work, and hopefully get a bounce in the stock to where you can at least break even, or get back into a profit scenario. Now, the main thing to watch out for here, what you don't want to let happen, is to let the stock run away from you. So you want to set some mental stops on where you want to get out of this trade if the stock really starts turning against you. Maybe some news came out, or maybe something came out where the stock is really pulling back hard. You don't want to just hold this put, because that's where you're going to suffer some big losses. So my kind of rule of thumb is, I'll never let these trades get more than about a 2 or 3 times loss. So just to clarify what that means, let's say you receive $2 in premium when you sold the put. That means if you have to buy it back for $6, that would be a 2 times loss. Again, you receive $2, you buy it back for $6, that means you have a $4 loss. That's a 2 times loss. I typically never let them get more than 2 or 3 times. So again, for a $2 premium that you receive, that would be like a $6 or $8. You want to get out of that trade at that point. All right, and one last scenario. What if the trade isn't really doing anything? So what if you're getting, you're at 21 days now. At 21 days, you really should manage that trade. It's not a good idea to hold these trades inside of 21 days. Again, research has shown that close to expiry, because of the volatility, it can really have some negative impacts on your account. So typically at 21 days, you want to do something with this trade. So my rule of thumb is, I look at the implied volatility ranking. If the implied volatility ranking is still elevated, I would just roll the trade to the next month. Now you're over the 45 days to expiry again, and just let the trade work. However, if the implied volatility ranking has really shrunk from the time that you put the trade on, and you haven't made any profit, say you're break even, or maybe just a really small profit or a really small loss, I would probably just close the trade and move on to something else. And the reason for that is, if the implied volatility already shrank, but you're not making any profit from it, it's risky to roll it to the next month, because you could get an increase in implied volatility, and that would then go against your trade. So that's really all there is to selling short puts. It's a pretty simple strategy. And like I said, the main thing to know when you're doing this type of strategy is how to manage it if the trade starts going against you. That's really your biggest risk. A lot of people are afraid to sell short puts, and yes, it is true. You have unlimited risk, but as long as you have a plan on how to manage it, if the stock starts going against you, and you get ahead of it before you get into those big losses, it's really an easy strategy to use, and a great way to generate income in a sideways, or even in a bull market, but especially in a sideways market. So hopefully that makes sense, and hopefully you can use this strategy in your own trading. If you're enjoying these videos, please hit the like and subscribe buttons, and we'll see you next time.